Welcome to the Deep Dive, your shortcut to getting smart on the stuff that matters in the business world. Today, we're really digging into the latest earnings call from Jack Henry & Associates, ticker JKHY. They're a really foundational player in financial tech.
Yeah, it was quite the call. Showcase, really solid financials for Q4 and the full year. But the interesting part was management's outlook for fiscal 26. Pretty prudent, maybe even conservative.
Prudent, yeah.
And that created this interesting dynamic, strong results versus this cautious forecast. So that's what we're going to unpack.
Okay, right, let's get into it. Quick look at the Q4 numbers first. So GAAP EPS, $1.75. That smashed the consensus estimate, didn't it? Something like $1.50.
It did. We're talking, a 17 to 20% beat, roughly?
Yeah.
And up 26% year over year. That's pretty significant outperformance. Shows good execution.
Absolutely. And revenue.
Revenue came in at $615.4 million. Also beat the street, which was looking for maybe $604, $605 million.
So about $10, $11 million higher.
Right. And that's solid growth, too. 9.9% year over year. Shows strengths across the board, really.
Okay, and looking at the full fiscal year 25, how did that shape up?
Equally strong, I'd say. GAAP EPS hit $6.24 for the year. GAAP revenue up 7.2%.
But the cash flow number really jumped out at me. Record operating cash flow.
Yeah, $642 million, which translated to about $410 million in free cash flow.
And that conversion rate, 90%. That sounds impressive. What does that practically mean?
It means fundamentally they're turning earnings into actual cash very efficiently. For every dollar they earn, 90 cents ends up as cash they can use.
Right.
And that gives them, huge flexibility to invest, maybe do acquisitions, return capital to shareholders, all without needing outside funding. It's a big plus.
Okay.
And the non-GAAP numbers looked good too. Adjusted revenue up 7.5%, adjusted operating income up almost 15%.
Which drove that margin improvement.
Exactly. Q4 operating margin hit 25.3%. That's a 290 basis point jump year over year, almost 3 percentage points, shows real cost discipline.
Okay, so by all accounts, a really strong financial year just wrapped up. Stellar numbers. But here's where it gets, like you said, really interesting. That guidance for fiscal 26, it points downwards, or at least to slower growth. So what's going on there? Why the caution after such a great year?
Yeah, that's the million-dollar question, isn't it? That interplay. Management's guiding for GAAP revenue growth of about 4 or 5%. Non-GAAP, maybe 5.8, 7.0%. And GAAP EPS between $6.32 and $6.44.
Which is a noticeable slowdown.
Definitely a slowdown from FY25. And they did point to a few specific near-term headwinds they're, factoring in.
Right. They mentioned things like industry consolidation, M&A activity, and also renewal timing. How are those hitting the forecast?
Well, the big one is what they call deconversion revenue. That's the fees they get when a client gets acquired and leaves the platform.
Okay.
That was almost $34 million in FY25, but they're guiding it down to only about $16 million for FY26.
Wow, that's a big drop. So they expect less M&A impact.
Or at least they're being more conservative about it. They also mentioned a specific large bank merger involving one of their clients isn't even in the FY26 numbers yet. Any impact there would be FY27. And interestingly, it's an in-house client.
Meaning they license the software but run it themselves?
Exactly. So the direct revenue hit isn't as big as if it were a fully outsourced client leaving. Still, it creates uncertainty.
Sounds like a complex puzzle to forecast. They also mentioned slower account growth. What's behind that?
Yeah, and that's, I think, a broader industry thing. It's not just Jack Henry. You've got neobanks, digital wallets, pulling customers away from traditional accounts. Institutions are cleaning up dormant accounts, too.
Mm-hmm.
Plus, macroeconomic stuff, right? Fewer car loans, fewer mortgages means fewer new accounts being opened overall.
So Jack Henry's clients, the banks and credit unions, just aren't seeing the same organic account growth.
Precisely. Which is why management is really pushing their strategy for small and medium businesses, the SMB space, trying to help their clients keep those deposits in-house.
Makes sense. And the other headwind was pricing pressure, even on renewals.
Yeah, they acknowledge that. Jack Henry usually commands premium pricing. They have sticky products.
Right.
But it's a competitive market. Clients are pushing back a bit on renewals and also on new deals. So Jack Henry adjusted their pricing approach, how they structure deals, even sales comp, back in the second half of FY25 to stay competitive.
So, okay, headwinds are real. Guidance is cautious. But they're not just sitting back. Let's talk innovation. What are they doing to drive future growth?
Well, the Banno Digital platform is still a huge focus, really high demand there.
How many clients now?
They hit 1,023 clients by Q4. And 14.3 million registered users. That user number is up 17% year over year.
That's solid growth.
Yeah, and Banno Business for the SMBs even got recognized by Datos Insights as a leading platform. So Banno's core to helping their clients compete digitally.
And they launched some new stuff too, right? Tap to Local and rapid transfers. Tell us about those.
Okay, yeah, these are potentially a big deal. Tap to Local, they developed this with a partner called MOV. It lets small businesses take card payments, like tap to pay, just using a regular iPhone or Android. No extra hardware needed.
Okay, so replaces the Square dongle or terminal.
Potentially, yeah. And here's the kicker. It's offered exclusively through the financial institutions, through Jack Henry's clients.
Ah, so the bank or credit union owns that merchant relationship.
Exactly. It keeps them in the game against standalone fintechs. Then there's Jack Henry Rapid Transfers, also with MOV. It's about moving money-fast accounts, cards, digital wallets for both consumers and SMBs. Again, helping their clients match the speed and convenience people expect now.
Interesting. And underlying all this is their big tech modernization push, the cloud strategy.
Definitely. That's the long game. They've got 20 components of their new cloud-native platform live now. And get this, 77% of their core clients are already hosted in Jack Henry's private cloud.
Wow, that's a high percentage already.
It is. And this shift, it stops them from, rebuilding the same thing over and over. It makes development faster, leaner, and enables new things. Like they successfully migrated clients to the new ISO 2022 standard for Fedwire. That's a complex, important upgrade for payments.
Okay, what about stablecoins? That's everywhere now. Any movement there, especially with that new Genius Act legislation.
They're moving carefully, strategically. The key is they plan to offer stablecoin solutions through their bank and credit union clients, not compete with them.
So enabling their clients again.
Right. And that Genius Act provides a clearer regulatory path, which they like. They see it developing over the next, say, 6-12 months. They're using their cloud platform, looking at partners, aiming to make stablecoins just another payment rail through their JKHY Pay Center, compliantly, of course.
Okay, so with that slower revenue growth projected next year, profitability and efficiency become even more crucial, right?
Yeah.
How are they managing costs and capital?
Yeah, good point. And they showed real strength here in Q4, that 146 basis point non-GAAP margin increase. That didn't happen by accident. It comes from a real focus on cost management, on doing more with the people they have.
They haven't been hiring aggressively.
Hardly at all. Headcount growth, excluding acquisitions, has been less than 1% a year for the last 5 years. It's impressive discipline.
So how do they do more with the same? What are the mechanics?
It's a few things working together. They do a lot of process improvement training. Something like 35% of their staff are green belts in methodologies like Lean.
Okay.
They're using AI more across different departments. And that tech modernization we talked about, it cuts down on duplicated work, all adds up to better margins.
And the balance sheet. Zero debt gives them options, I imagine.
Huge options. That record cash flow, zero debt. It's a great position to be in.
Yeah.
They signaled they'll likely increase share buybacks, maybe at least $100 million. And they're always looking opportunistically at M&A, plus recent tax changes, letting them fully expense R&D costs and use bonus depreciation should boost their free cash flow conversion even higher, maybe 85-100% going forward.
So even more financial firepower.
Exactly, more flexibility.
Okay, so strong finish, solid strategy, but a cautious outlook. How did the market take all this in? What was the reaction?
It was interesting. The stock ticked up initially, maybe close to 2% on pretty high volume. So not panic, more like constructively neutral.
Constructively neutral, I like that.
Yeah. Investors clearly saw the good FY25 results, the margin improvement, but that FY26 guidance being maybe 1% below what some expected definitely put a lid on things. And you have to remember, Jack Henry stock has actually lagged some other software stocks like the IGV ETF benchmark recently.
Right.
So the market seems really zoomed in on that slower FY26 growth, even though management sounds confident about the pipeline and the cloud transition.
So that disconnect you mentioned earlier, strong operations, solid plan, but near-term caution is weighing on sentiment. What are the main takeaways then for listeners looking ahead? What should they watch?
I think the long-term story is still about that shift to the cloud, digital workflows, sticky revenue, great cash flow. That hasn't changed. Near term, you got to watch those deconversion numbers each quarter, see
Right.
how they track against that lower guidance.
Okay.
Look for adoption metrics on new products like Tap2Local. Are clients actually rolling it out? Are businesses using it? And their big client conference, Jack Henry Connect, is coming up in Q1 fiscal 26. Any big contract wins announced, there could be a catalyst.
And keep an eye on M&A activity in the banking space generally.
Definitely. And just the overall pace of revenue growth through FY26, see if it starts to reaccelerate as the year progresses.
All right. Now for our favorite part, the This Is Not Financial Advice segment.
Yeah.
Time to put on your hedge fund analyst hat and give us an outrageous but plausible trade idea. What have you got?
Okay, here's the pitch. Go along Jack Henry, JKHY. Target a 12-month upside, let's say 20-25%.
Bold. Why?
Because I think the market is seriously underappreciating their picks and shovels advantage in that community bank and credit union space. It's fragmented, and Jack Henry is essential plumbing.
Okay.
Yeah, the FY26 top-line growth looks soft, but peel back the onion. A lot of that is temporary M&A noise and some renewal timing stuff. It's not, I believe, a sign the core business is weakening.
So you think the underlying engine is stronger than the headline number suggests?
Exactly. Look at the platform stickiness. Look at Tap2Local and rapid transfers rolling out to those 1,000 plus Banno clients. That's quiet, compounding revenue building up. And remember, they are enabling their clients, the banks, the credit unions, to fight back against fintechs and SMB payments, and eventually maybe stablecoins. It's compliant, integrated.
It's not a direct-to-consumer play. It's an infrastructure play for the existing financial system.
Precisely. It's a bet on community banks surviving and thriving by using Jack Henry's tools. Zero debt, buybacks ramping up. Management can smooth over short-term bumps while these embedded solutions just keep growing. They're insulated from direct fintech competition in a way many others aren't. The market's missing the compounding power of that invisible infrastructure, in my view.
An interesting take. Betting on the enabler, not just the disruptor. So wrapping up, Jack Henry had a strong FY25, no doubt, but they're stepping into FY26 with a more measured stride, navigating some industry shifts while pushing hard on innovation.
That sums it up well. They've got challenges, sure, but also a very clear roadmap focused on digital, cloud, and new payment tools to help their clients win. It's a balancing act.
Well, this has been the deep dive getting you up to speed. Remember, everything we talked about today is just for informational purposes. It is absolutely not financial advice. Please do your own research. Think about what stood out to you from this list of good veg.
Yeah, and if you have thoughts or questions, let us know what you found interesting.
Thanks for tuning in.